Is your estate plan optimized to pay the least amount of taxes to the government when you, or if you're married, when you and your spouse pass away? Do you know that some trusts can get assets out of your taxable estate very efficiently? In today's video, the second of a series, my colleague, licensed estate attorney Kevin Ducombe and I will outline two very useful trusts to tax efficiently gift assets out of your estate: the Irrevocable Life Insurance Trust and the Intentionally Defective Grantor Trust. We'll break down what they are, the benefits of using them, and lastly, provide examples of how they help physicians. Hello, everybody, and welcome to Wealth Matters for Physicians by Altfest Personal Wealth Management, the channel that provides key investing and personal financial planning insights to help physicians achieve their key life goals. Before I bring in Kevin, a few words about Altfest. For nearly 40 years, Altfest Personal Wealth Management has been helping physicians holistically optimize all areas of their personal financial lives in a fully objective, no commissions manner, while as a legal fiduciary, always putting our physicians' best interests first. As physicians, you'll probably also want to know that Altfest is the preferred wealth manager for members of the Medical Society of the State of New York, and the preferred wealth management education provider for both the New York chapter of the American College of Surgeons and the New York State Society of Orthopedic Surgeons, just to name a few of our medical association partners. As I mentioned, my guest today is Kevin Ducombe. Kevin is a licensed estate attorney, an MBA, and a senior financial planning and estate specialist at Altfest. Before joining Altfest, Kevin was a trust officer at Comerica Bank and most recently was a consultant to financial advisors at Commonwealth Financial. A final housekeeping note: this video is for educational purposes only and not intended as specific advice to any specific viewer. Before taking any estate planning actions, please speak with a licensed estate planning attorney in your area, as well as your wealth management advisor and your CPA about your specific situation. So Kevin, thank you very much for being with us today on Wealth Matters for Physicians.
Thanks for having me.
Well, let's get into it. Today we're talking with Kevin about two advanced estate planning trust strategies: the Irrevocable Life Insurance Trust, or ILIT, and the Intentionally Defective Grantor Trust, or IDGT, which is a mouthful. So Kevin, could you just tell us what an Irrevocable Life Insurance Trust is in broad strokes, and how does it work?
Yeah, so basically the ILIT structure is an irrevocable trust, and it's going to own a life insurance policy on the grantor, and that's the person that's creating the trust, transferring the funds into the trust, that sort of thing. Now, ILITs are a little bit unique because they do involve an insurance policy. So some spouses will opt to purchase what's called a second to die policy, a life insurance policy on both of their lives. And so in the ILIT context, they would both be the grantors of the ILIT as well. So there's a couple different flavors with the ILIT, but the basic point of it is that it's a trust that's going to serve as the recipient of the death benefit after the death of the grantor or grantors in certain cases. And what that does is really help provide some tax benefits.
Right, let's go into that. So what's the main, very explicitly, what's the main benefit or benefits of using an ILIT trust? Why doesn't someone just own a policy and when I die, then my wife will get the money? And why do I need a trust for this?
Yeah, so I think of it as sort of the triple tax benefit trust. So the ILIT will, first and foremost, and this is pretty important because some people will lose track of this, you may have an estate that when you look at all your liquid assets, you don't have an estate tax concern. So all your brokerage accounts, your retirement accounts, that sort of thing. But let's say you had a $3 million life insurance policy on your life. If you own that death benefit gets added on top, and you might have an estate tax concern because of that alone.
That's included in your estate.
Exactly, it's included in the estate value. So the number one benefit right off the bat of the ILIT is because the ILIT owns the policy, that death benefit does not get included in the value of your estate, even though it's going to functionally serve the same purpose, right? It's going to kick in when you pass away, and it's going to ultimately go to your beneficiaries or your spouse, however you've designed it, or for their benefit. So number one right there is just sort of helping to mitigate or reduce estate value, which hopefully also reduces estate tax payments.
Great.
The second one is to convert or remove taxable funds out of your estate. So the idea that you're gonna have to pay the premiums one way or another to purchase the life insurance policy. So you're gonna take some money that was in your estate and again could have been subject to estate taxes, and you're gonna move it over to the trust, and now it's gonna convert into something that is outside of your estate. As we just discussed, it's not going to be included in the value of your estate. And then lastly, it's still going to have that tax-free death benefit. So when that death benefit is paid back to the trust, much like if you own the policy outright, your beneficiaries will get something that is effectively a tax-free payment. So hopefully there's a little bit of leverage going on too, in that your premium payments were hopefully less over time than what the eventual death benefit was. But
Great.
Really a lot of great benefits with the ILIT for sure.
Now that's really excellent, because people may or may probably know that life insurance, the death benefit is income tax free, but then by putting it in the ILIT, it also becomes estate tax free.
Yeah, absolutely.
Excellent. So Kevin, because we have a lot of physicians in the audience on our channel, Wealth Matters for Physicians, how could an ILIT be very useful to a physician who is either a partner in a medical practice or maybe a small practice owner?
Yeah. So I think this is one of the least discussed ILIT arrangements, if you will, that you can use the death benefit to help buy a practice or help facilitate a succession plan with your partners, or as you indicated, if it's a solo practice. And this could often be when something happens somewhat unexpectedly, but it's enormously beneficial to have it in place just in case that were to happen. So basically what's going to go on here is that your death benefit, as we just discussed, will pay into the trust. Now your trustee can turn around and take that money and give it to your estate, which if you hadn't done much other estate planning is the owner of your practice if you pass away, particularly unexpectedly. So what the trustee will do is essentially trade, right? They've got a bunch of cash now. They're going to trade it to your estate. The estate's going to give the business to the trust. Now the estate can proceed efficiently. They've got enough cash if they have to pay any expenses. If they have to pay taxes in particular, they've got the money to do so. And then hopefully they can wrap up that court proceeding pretty quickly. Now your trustee, and hopefully again, your ILIT has provided some instructions in this situation, but your trustee can now be the one that facilitates either some sort of transfer to your other partners, some sort of succession plan maybe that you've established, or again, often in the case of something unexpected, it may be the case that it's just the goal is to liquidate that practice, sell assets or sell the practice if possible, get those proceeds back to the trust, and then those will go to benefit your family members down the road. So it's a really nice vehicle to just create a lot of efficiencies and really help streamline the process.
Right. That sounds excellent. And yeah, it's definitely very complicated. So again, we advise you to be speaking with your estate attorney and also speaking with your financial advisor, your comprehensive wealth advisor, and your CPA on this. Now, changing the subject, Kevin, what is an intentionally defective grantor trust? Again, in broad strokes for the audience.
Yeah, so generally speaking, again, it's going to be this irrevocable trust shell. And this one is really designed to receive gifts from the grantor. And in particular, receive gifts that are going to count as taxable gifts, those ones that are going to count against the lifetime exemption. So you can almost think of it as a trust designed to intentionally use your lifetime exemption. Now, the defective component is kind of a unique little quirk, which the tax code considers defective because I think they thought nobody would want to pay taxes. But what it means is that the grantor, the person that just made a gift into the trust, is still going to pay income taxes on anything going on inside that trust as if they didn't create the trust at all. So when we're talking about income taxes in this context, that would be the dividends, the interest. If your trustee sells some assets for capital gain, it could be that. That's all going to flow back to the grantor's personal income tax return. Well, it's called defective in the name of the trust. A lot of people sell this as an additional benefit because it's effectively more gifts going back to your beneficiaries in the form of allowing the trust to grow without having to pay any income taxes. So it really benefits everybody overall in that respect.
Great. And I know you already in the last in your last answer touched on this a little somewhat, but very explicitly again, what are the benefits? Physician came and said, Kevin, bottom line, IDGT, what are the real benefits of this thing?
Yeah, so like you said, you could think of those as benefits as well in sort of the design of the trust in and of itself. But the additional benefits here are really that you are moving assets out of your estate, you're moving growth out of your estate when you do this, and you're also creating some protection. So there is a sense that if you're creating this properly, everything is being respected in that once the assets go into the trust, the trustee's in control, there's separate accounts, you're not benefiting from it anymore as you've truly passed the asset on. There can be creditor protection in that case. There can be creditor protection for the beneficiaries as well, because it's going to remain in that trust. So there's a whole host of additional benefits in that you've crafted something that is now available to your beneficiaries and potentially generations of beneficiaries, all while also creating some of that estate tax benefit that we were talking about earlier.
So Kevin, that sounds really interesting about intentionally defective grantor trusts on a conceptual level, but could you walk us through a specific example, because examples always makes things more tangible?
Yeah, absolutely. So we'll take a look at the example of Dr. Sally and her husband, Roger. They're married, they have 3 adult children. Dr. Sally's 65, Mr. Rogers 66, so they're both nearing retirement. They've got about a $10 million net worth and about $5 million in after-tax brokerage account. It's 2022 though, so they've suffered some significant losses, as many people have in the markets. But even still, they've got that $5 million sitting there in the after-tax account. So what they're kind of concerned about is they understand that, well, they have a little bit of a depreciated estate and are technically under the New York State estate tax level. Throughout their retirement, and if there's another business cycle, another bull market, their estate could appreciate quite rapidly again, and they could end up with an estate tax concern over time. So they're kind of curious, is there something intentional and proactive they can do now that would help mitigate some of that concern down the road? And one idea would be to fund the IDGT, the intentionally defective grantor trust. So in our example, what they're going to do is they're going to take a look at their portfolio. They're going to look for about $1 million in cash that they can raise by selling what are unrealized losses. So they're going to realize some losses. That's going to give them some immediate tax benefit on their own taxes. They're going to turn around and send that $1 million cash to the IDGT. The trustee is going to reinvest it effectively as if they had done the same thing within their portfolio, just done tax loss harvesting and reinvested the proceeds. But they're just kind of carving something out now. They're going to transfer it on. They're going to put it aside for the next generation. But in doing so, what they're going to put aside is the growth as well. So if we look at their approximate 21-year life expectancy and we have it grow about 5% annualized, that trust could be worth about $2.785 million at the end of their lives. So all of that $1.785 million of growth above the $1 million we started with is completely out of their estate as well. And as we talked about, there's this defective component where they're going to still pay taxes on all this money. So if we assume that's about $30,000 a year, if you think about that over the 21 years, that's about another $1.1 million out of their estate and really benefiting the next generation. They're not paying any taxes. They're using up a little bit of exemption, but by doing this, they are going to set themselves up to hopefully keep their estate value in check, because again, they've just sort of carved something out. So they've taken some nice steps to hopefully prevent any estate tax issues down the road.
That sounds great, Kevin. Thank you very much. Very nice example. It kind of hits the points home, going from conceptual to very specific. So thank you very much. And anyway,
Absolutely.
Also, thank you so much, Kevin, for being on Wealth Matters for Physicians today. You've given our physician viewers some very helpful information to think about it, and we really appreciate it.
Absolutely. It's been fun. Thanks.
If you'd like to discuss the information explained in today's video, receive a complimentary analysis of your investment portfolio or a retirement readiness analysis, or discuss any of your other personal financial planning areas with an Altfest professional at no obligation, please contact my colleague Jesse Freeling at 212-796-8732, or by emailing Jesse at his email address, which is also in the description of today's video below. If you liked today's video, please click the subscribe button below and hit the bell icon to receive notifications each time we release a new one. If you think that a fellow physician would find this video interesting or useful, please share it with him or her to help them also get their finances optimized. Lastly, as always, if you have topics you'd like us to cover, like or dislike certain things that we're doing, or have any other feedback, we'd love to hear from you. So please share your comments in the comments section below. Well, that's all for now, physicians. Thank you very much for watching today's video, and I look forward to being with you again in our next one. Until then, be well, and remember to keep on optimizing your finances, or let us help you if you'd like.